In this lesson, we want to look at another topic, freshness of a zone. Freshness is one of our key factors for a good zone, and actually means how new is a supply or demand zone. Why is this important? We want to make sure that we are moving in the same directions as the institutions. So, of course, we have to follow them, but ideally, follow them as quickly as possible. And because we never know where the target are, there's an uncertainty. Targets can change. Institutions can move the market in a certain direction, but have the intention to send the market the other way. And if we are too late, then we end up falling victim of this counter movement. And we want to avoid that by thinking about when we should pay attention to a zone and when not. And I've illustrated these rules for you here, and I like to call them the freshness of a zone. We want to look at how the market returns to a zone and how often it has already been there. And with that, we really separate ourselves from the topic of support and resistance, because we explicitly look at when the market enters the zone and how often. If it touches the zone more than twice, we no longer want to be there. For us, the best case is when a zone has just emerged, as in the example on the left. Here you can see we have run into an area, the market has reacted and delivered a structural break, signaling to us that, hey, here's a zone from which you can now trade. What we ideally do is to trade the first retracement directly, because then this zone has just emerged and we have the best risk-reward ratio because we can follow the institutions very early on. A second retracement would also be fine, as you can see in the example on the right. Here, the market comes back a second time because it may have to take certain positions out of the market again. This concept of the market having to come back a second time is called mitigation, and we will also deal with this later on in another video. In this case, we can also trade the second retracement. The second retracement is acceptable, but not as safe as the first one. The problem we also have is how many positions should an institution divide its capital between? 2, 3, or even more positions. We don't know that. So we cannot judge that, and therefore we have to build in a kind of safety mechanism so that we do not trade infinitely often from one zone. So please always remember, first return is the best, second return is fine, third return we no longer want to trade. Here in the third return, the probability is simply high that no more positions will have to be split up by the institutions. So that more likely a breakout will occur and we will just run through the zone. But let's take a look at the live market example to simplify it even more. So let's go through the key factors again, then it hopefully will become a bit clearer. As we spoke of in a video earlier, we have 4 key points that determine a good zone. First of all, we want to sweep liquidity. We have this zone right here. This zone swept liquidity. Point 1 covered. This zone made a break of structure towards the bottom. Another point covered. This zone has built up liquidity, as you can see here, these 2 highs, that can be swept and then be taken for another downwards movement. And we also see a gap before this zone even emerged, with big momentum candles. So we have all 4 points covered. This means that we could wait for a retracement into the zone and simply just go short in the zone. Maybe cover the low and then we would have this trade. Here we see the first touch would have been a good trade, but also we see a second touch. Here the second touch also fulfills some requirements. There is no break of structure though in this one, but we see we also built liquidity up here that we didn't take, and this is the second touch. This one is still acceptable, this would have been good. In this example, you could have traded both. In this example, both trades would have been perfect for us. Here in these zones, we can clearly see that the institutions are active, and thus we have a good risk-reward ratio to enter here with the first touch and with the second touch. Because after this movement, we know the institutions are short. We have a consolidation here, which the institutions use to kick out their long positions they established in the market before they went short. So basically, they take out their long positions here and establish new short positions with these 2 retouches. And thus we know the market will move down more short. In the next video, we will look at mitigations. See you later.